And here we go. Okay.
Okay. Are we ready? Everyone ready? Okay, welcome Evergreen GovCal clients and our Haymaker founding members, and a very warm greeting, especially to our esteemed guest, Jesse Felder. And many of you listening to this Zoom know his work because we've run a number of his excerpts over the years. And in my opinion, Jesse is the most straight talking and writing financial expert I follow. His recent podcast with my other good friend, Adam Taggart, is a great example of that. And after this, if you feel like you need to get more Jesse, just go right to Adam's Thoughtful Money website and you can find that. And I just can't recommend Jesse's work and his intellect and his honesty high enough. He's one of my absolute heroes in this business. So as usual, we're going to have you guys on mute for the first 35, 40 minutes, and then we'll get to the Q&A. And I hope he enjoys this discussion with my good friend Jesse. He's a treat. So let's get going with everyone's favorite topic, and it's not the slide disclosure or the disclosure slide. We can skip over that, but it does say at the bottom that it's always a good idea to use a financial professional whenever you hear ideas from me or from anybody else that's part of the Haymaker process. But the favorite topic, of course, is the stock market, at least when it's going up. But this continues to be a very unusual bull market. And one stock, which we'll talk about later in the podcast, has produced about 40% of this year's S&P return, one stock. So that gets right to this next image, which is the incredible narrowness or breadth, bad breadth, which I call market halitosis, that this market has been displaying for quite a while. But it's frankly getting worse, not better. Now, I think that's pretty well known, but I think a few of the things that Jesse is going to bring up here in a moment. In fact, it's called his 350s if we go to the next. So Jesse, take it away on that topic. We've got the insider selling, which I know is one of your 350s.
Yeah, this is something, the insider activity, that I've been following since the start of my career. I co-founded a hedge fund firm where we did a lot of in-depth research in regards to insider behavior. And this indicator in particular is just the total dollar value of insider sales to insider buys. And these are corporate executives and directors, managing these companies. And so, this is the 13-week trailing ratio. And it recently went over 50 sell to buy, which is the highest that we've ever seen in the decade plus that I've been tracking it this way. Najat Sehun, who's professor of finance at University of Michigan, has done some of the greatest work to demonstrate that this type of insider activity is not just a great forward indicator of stock market returns, but also of the economy. He uses more of like a 12-month ratio, which is also about as elevated as we've ever seen right now, to forecast stocks prices and the economy over a 12 to 24-month period. So insiders are about as bearish as you'd ever want to see them.
Okay, and then we've got another 50, which is kind of an interesting one here that a lot of people have heard about, I think, that are part of this, but don't really understand.
Yeah.
Titanic syndrome, Jesse. And as I understand them, and you know much more about them than I do, that when they're sporadic, they don't mean that much, but when you get clusters, that's when the warning signal is much stronger. Is that fair to say?
Yeah, I mean, that's a great point, right? The Titanic syndrome is very similar to the Hindenburg omen, which is another one. They both have these very, scary sounding names. But they were developed as a signal to, I guess, increasing dispersion within the index as kind of a breath warning. And when you get one or two of these signals, it's not really that worrisome of an issue. But when you get a number of them, it's something I've studied again for a few decades now. Essentially, the Titanic syndrome or the Hindenburg omen are triggered when the stock market index, S&P 500, in this case, we're looking at the New York Stock Exchange and the NASDAQ composite. When these indexes are at or very near a new 52-week high, And at the same time, you have a number of components within the index that's hitting a new 52-week low. And really, in a healthy bull market, you shouldn't see a lot of stocks making new lows. So when you have an index that's making new highs, but a growing number of the stocks under the surface are actually making new lows, that's a warning sign. When you get, a number of these signals triggered over a period of time, it usually is a pretty good early warning signal of a trend change, of a significant correction or a bear market. This is the Titanic syndromes on the NASDAQ that we've seen over the last 3 months. But the 50, that I was referring to is the 50 Titanic syndromes across New York Stock Exchange and the NASDAQ over the last 12 months. But specifically over the last, the first 3 months to start this year, we saw a significant number of these on the NASDAQ. And typically that's been a prelude to market weakness over the months to come.
Cool. So the next 50 is related to this because I think it's the PE on the Magnificent Seven. And that's actually not with this visual we'll talk about here in a moment, but we don't have a visual on the PE. But we know, I think, that the valuations of the Magnificent Seven have been extremely high. So I think recently it did hit 50. But what's also interesting, and it further speaks to this narrowing, is the Magnificent Seven is probably down to the Magnificent Two, maybe the Magnificent One.
Yeah.
And that, of course, we'll talk about in video later. But that's also, that kind of a valuation is a classic warning sign. We've seen things like that in the past, in the late 20s or in the Nifty 50 era of the early 1970s, which did not end well, even though those were a lot of great companies. And if you held them long enough, you did okay, but you had very poor returns over the next 10 or 15 years just because valuations got so high.
Right.
And another thing that we're, and so, I mean, in looking at the latest data on the Magnificent Seven or whatever the number is, are you still seeing these very high valuations?
Yeah, and specifically what I was looking at was I aggregate the market cap of those 7 companies that are the largest in the index and compare that to your aggregate free cash flow. And when you do that and you look at an aggregate price to free cash flow for those 7 companies put together, it recently went over 50 times. And to me, that is a sign that investors are paying a multiple that discounts massive earnings growth in the future, right? The only way to kind of justify a 50 times free cash flow is if all that CapEx that they're spending on AI and these types of things pays off in terms of big earnings over the next growth over the next 5-10 years. And I think that's a very difficult case to be made, that the numbers are getting so large in terms of revenues, profit margins, and earnings growth that it's going to be very difficult to justify those multiples. It's also very interesting that that is the most extreme multiple that we've seen, since before Meta came public as a company, since before Tesla went public. So this is the highest valuation we've seen for this group in their history. At the same time, revenue growth is slowing, earnings growth is slowing significantly, right? This is why it's gone, basically the Magnificent One now is kind of the NVIDIA is still showing rapid revenue growth, earnings growth. But Apple, top line sales are negative. Earnings growth, minus buybacks and things, would be negative. And so you're starting to see, a significant, even including the gains within NVIDIA, when you aggregate it, the growth in earnings and growth in free cash flow in these companies has slowed dramatically. At the same time, the valuation has really gone to a record high.
But what we've had offsetting that, of course, is tremendous momentum. And that's really, this visual is courtesy of you also, and the amount of outperformance by momentum related equities. And that is also a warning signal. We can look back and see it on this visual that prior periods like this, which really there's only one that exceeded, which was the early 2000 top of the tech bubble. And of course, that led to the NASDAQ going down almost 80% over the next 2.5 years. Again, we get another visual here that is a good one, which are very relevant. This, go back one there to the meme stocks, because, you wrote it up here, I think on May 2020, something like that, talking about what was going on with GameStop and AMC at that point. And then yesterday, of course, GameStop went up at one point 100% in one day because of a screenshot of Roaring Kitty, aka Keith Gill's personal account, showing a massive position, mostly in GameStop options. And actually, I saw Jesse from Mike O'Rourke, the closing print, where he did a volume-weighted analysis of yesterday's trading, and based at where it is today, investors on average lost $70 million already by buying into that frenzy. And it's just amazing how this just keeps happening. I mean, they got destroyed back in 2021 when GameStop and AMC first went postal, along with a few others. The one that has resisted the gravitational pull so far is Carvana, one of my personal bet noirs, if you will. But anyway, this is not normal behavior. This is all indicative of out of control speculation, the kind of behavior that you see at market tops. And I don't think you would argue with that point. Is that fair to say?
Not at all. And you know, just to kind of come back to the insider stuff, I actually wrote up Carvana a couple of years ago as a trade idea on the long side on my website, because the insider buying had been so strong by Ernie Garcia and his father. And they've been such great traders of this stock that, you know, they were buying it under 20 bucks a share, went over 100. And in the last couple of weeks, they've together, the two of them, sold about $150 million worth of stock. So it's such a great signal for companies like that, where you have insiders that are really good traders. But I think, to your point, what we've seen is a dramatic rise in animal spirits that's really reminiscent of what we saw in 2021 before the market rolled over into that 22 bear market. As you saw all the meme stocks going crazy, we're seeing this again. And the Financial Times published a piece over the weekend showing that it's not just these meme stocks, penny stocks, volumes in penny stocks are hitting record highs. But we should also not fail to mention that, you know, what's driving NVIDIA? NVIDIA, since it announced earnings, has gone up $500 billion in market value in 1 week. And what's driving that is a massive amount of buying, speculation in, zero data to expiration, call options, and these types of things. It's a gamma squeeze, right? So you get a lot of the stuff we saw in 2021, where you have massive amount of call buying. The options dealers end up being, short calls and have to buy stock to hedge their underlying position when it goes up. And so all this massive call buying creates a massive amount of demand for the underlying shares. And it's driving a stock like NVIDIA up $500 billion in 1 week, which is, it gained more than a Tesla in 1 week. And if you believe Tesla is overvalued, dramatically overvalued, then, you have to think, that NVIDIA gaining a Tesla in market cap in 1 week is pretty extreme sign of animal spirits in the markets right now.
Well, time alone, we've got a section on NVIDIA, so we can come back to that. But
okay,
let's talk. I know one of your favorite areas, just like mine, is hard assets. So that's really our next section here. And hard assets were behaving in a very firm manner up until recently, when they're going through a not too shocking correction after the move that they've had. So let's check out our next visual here. And this is actually, I believe, from you. Yes, this is the Felder report. And it's a very interesting chart. So this is really showing the downtrend that commodities have been in since the invasion of Ukraine, when they really spiked for obvious reasons. And we'll talk about that impact on inflation, because I think that's underappreciated, the benefits that's given to inflation. But some of the founding members here received last week Louis Gav's, my partner's excellent Got Commodities piece. And, when you go through these corrections, it's like, oh, well, was that a really good call? And this is a call or an anticipation that is going to play out over many years, if we're right, that some of these things that are pushing up the price of commodities, including the great green energy transition, those aren't going away. And we've also got this situation where we've got a tremendous amount of fiat currency debasement going on in most Western countries. We'll talk about that a little bit more. So, this is an area that Jesse and I both like, and yet very little interest on the part of retail investors, as we're going to see. So let's go to the next image. We had tremendously bullish breakouts on gold and silver. Gold broke out to a new all-time high, and most Western investors greeted that with a big yawn. Silver also broke out, although not, it's a multi-year breakout, but not an all-time high. In fact, I think the all-time high was actually set in 1979 when the Hunt brothers tried to corner the silver market. But anyway, these are powerful signals that something big is going on, I think gold is particularly meaningful because it's becoming the new reserve asset for central banks around the world, increasingly replacing U.S. treasuries. And I think that's got big time implications. Okay, we'll go to the next one. And this is from Jesse, and it really drives home what I was just saying. It's just how little exposure, and this is institutions who you would think would know better, would be more diversified, very, very little. So I'll stop there, Jesse, and any comments you want to make on this particular point.
Yeah, I think, it's important to point out that the time frame for this type of a bull, bullish call. I've been bullish precious metals really since 2015, and I've been really bullish energy since the oil price briefly went negative in 2020. And I think we're still in the very early innings of a new commodity super cycle. I think I would just point out that Jamie Dimon has been all over the press over the last couple of weeks talking about his idea that inflation is going to prove a lot more persistent, sustainable than markets currently have priced in. And that comes back to, deglobalization, growing militarization, growing, fiscal imbalances, and demographics issues that put a strain on the working class of the society versus growing non-working population, the aging of society. So I think there is a big bull case to be made for the long-term positive trends for these types of assets. And it's very fascinating to me that investors, given that, that very compelling case, investors have zero interest in owning energy or precious metals. If you look at just the flows going into sector-based funds, everything's going into tech. The worst, sector for attracting capital has been energy. And there's been consistent outflows out of precious metals ETFs for months and quarters now. It's amazing to me to see the prices breaking out like this and investors jumping ship at the same time. It's really, something like we've never seen, I think, in the asset.
We got a visual of that coming up here. Let's go to the next one.
Yeah,
So
this is the Sprott. The Sprott Silver and Gold, Physical Silver and Gold Trust. It used to be the Central Fund of Canada. This is an indicator I've watched for a long time. It's just the price relative to the net asset value. And to me, I don't know of anywhere else really where you can go buy physical gold and silver at a 5% discount to the market price, right? Like you can in this ETF or in this closed-end fund. I'm not paid by Sprott, compensated or anything for saying this, but it's fascinating to me that we see such a discount to the net asset value of the underlying assets, gold and silver and storage, that this fund owns, even as prices breaking out in such a strong way. To me, it's a very clear sign that sentiments are nowhere near you would normally see them kind of at the top or the end of a bull market. This is the exact opposite of what we saw in 2011. I think this fund traded at like a 10% premium to net asset value back in 2011 at the last major top for precious metals. So to me, all of this kind of points to the same direction, that we're still in the very early innings of this bull market in hard assets.
Well, you may not be biased on this one, but we are. Evergreen clients have a very large position in this one, and it's been a nice performer for us. And frankly, for anybody on the call that isn't an Evergreen client, which are quite a few of you, it's actually a very good way to own gold and silver. It's held at the Canadian National Mint. And as Jesse said, I mean, the discount frankly pays the management fee for several years. And it could at some point conceivably, and I think will trade at a premium again. Okay, let's go on to the next one. And I do think this is a question I threw in here that a lot of people are thinking, okay, well, we want to be ahead of when the Fed starts cutting rates. And I think you got to be careful about that, because if the Fed cuts a little, that's generally bullish. If they can achieve a soft landing, I'm skeptical we're going to see more on that coming up on the economy. But if they cut a lot because they're worried that we are into a recession, that's typically when the stock market struggles, in some cases gets crushed. Whereas precious metals love that type of thing, very aggressive central bank easing, would be rocket fuel, frankly, for the precious metals. Okay.
Yeah, I think I would just point out that when you look back at the previous cycle, the monetary cycle, from 2018 through 2021, and you look back when the Fed, the quantitative tightening began to create problems in the repo market, that's when the gold price really started to take off. And when the Fed cut interest rates dramatically during the onset of the pandemic, gold really started to scream higher. And I think we're in that kind of in-between stage now. Fed is done hiking, gold's starting to anticipate problems potentially with being able to maintain quantitative tightening and starting to anticipate rate cuts. And that's why I think it helps explain the strength we've seen in precious metals recently. But once the Fed does start cutting rates, yeah, it'll be off to the races.
And I would add, I think if you want to turbocharge this effect, you look at the miners, the gold and silver miners, which have been coming to life, but for the most part have been big laggards, not just recently, but for years. Excuse me.
Yeah,
So,
to me, that's another sentiment signal. When you look at, I just look at the ratio of, something like GDX relative to GLD, the metals versus, I'm sorry, the miners versus the metal. When you see that underperformance of the miners versus the metal, that's a sign that sentiments towards the space are pretty bearish. And so I think that, that's another indicator pointing to the fact that investors really have no interest in precious metals right now.
and amazingly, they continue to buy bonds. So you see these outflows out of energy, you see outflows out of gold, and you see inflows into the long-term bond ETFs. And so that's really a lead into our next section. I'm old enough to remember when bonds were derisively referred to as certificates of confiscation back in the late 70s, early 80s. And actually, I became a bond bull in the early 80s, believing that Volcker meant business, and was pretty much a bond bull with a few exceptions for 40 years until we got to the summer of 2020. And the 10-year got down to around a 50 basis point, 0.5% yield. So it's been as we'll see next, it's been a brutal period for long-term government bonds, long-term U.S. Treasuries. So next image on that. So really, worst bear market in over 100 years. I think probably the worst bear market for long bonds ever. Maybe in the Civil War during a high inflation period was comparable, but I don't know. We're not going back that far. This is far enough to make the point. Now let's go to the next one. And I think what we'll see is that even going back over, well, basically for this century/millennium, there's been no real return on treasuries. And it would really look bad if you price treasuries in gold. You would have deeply negative returns on treasuries over that period of time, but this is bad enough. So we are getting into a situation where bonds are, as they were when I first entered the business in the late 70s, basically return-free risk. And I think we're in a very, very long bear market for bonds where there will be trading rallies. And maybe that's what we're starting to see now, or some trading rallies, trading opportunities, but you're going to have to be very dexterous to take advantage of this. Okay, let's go to the next one. Inflation. So the belief was that, particularly at the end of last year, early this year, that inflation was going to come down. We were going to get 6 or 7 Fed rate hike cuts, or Fed cuts as a function of that. And there was also belief that we were going to get a soft landing. We'll talk about the economy in a bit. But inflation has been unpleasantly sticky for the Fed. And we can see that in the next image, which is, this is kind of funny in a way. This is the super core CPI. This is not X housing. So the one X housing is actually running a little bit over 6%, but this one's bad enough. And you can see that it's actually hooking up. That's not what the Fed wants to see. Jay Powell may have made a big mistake because he chose this one as his favorite inflation measure back a couple of years ago when it was the most flattering to his what was then inflation as transitory theme. So he picked that one, and I think he regrets it now because it's not looking too hot. But even if we look at a more, the next image, traditional CPI measure, it's running still kind of in the 4% zone. 3 3/4 to 4.5 projected by November 23. And I made the point earlier about that big price decline in commodities, and particularly energy, that's happened since the invasion of Ukraine. And the reason that matters is something like 70% of the inflation improvement that's happened since then has been because of lower energy prices. And if those energy prices start to turn around, oil is on its heels again this week, I think for bad reasons once again, but we probably won't get into that unless somebody wants to ask in the Q&A. But I think we're going to be in a rising commodity environment, and particularly driven by energy prices. Natural gas prices have already started to come back up. So if energy prices go north rather than south, and maybe after the election, you know, I won't get into the conspiracy theory arguments about why that might be happening now to kind of depress energy prices, that's going to make the Fed's job even tougher. So, you know, this is, to me, this environment seems pretty stagflationary, because we're going to see here in a moment that the economy itself isn't looking too great. And this is a pretty big change that's going on that even the talking heads at CNBC are picking up. So let's look at the economy. That's kind of a funny cartoon that my friend Mark came up with. But the Goldilocks idea that we're going to have this not too hot, not too cold economy has been the dominant mindset on Wall Street. That's a very soft landing type of thing, very good for the stock market because the Fed can ease a little bit, takes the pressure off of inflation. But all of a sudden, we're starting to see some very weak economic data. And this is one example of it. You can say, well, it's manufacturing and that's not as important as services, but even services have been easing. Let's go to the next image. And, you know, we've got one of the longest yield curve inversions ever. It's become very fashionable to blow that off, say it doesn't matter anymore. Leading economic indicators have been some of the weakest they've ever been. I think there was one positive month in the last 25. And then if we look, you know, Chicago is a very important regional area. And there's definitely a chill wind blowing from the Windy City. If we can look at the next one. Oh, that's actually coming up in a couple more. Sorry about that. But this one, I think I inserted this at the last one because it just came in and it's really a shocker. And this is what's got the talking heads on CNBC really concerned, is how this Atlanta GDP now, which tends to be pretty optimistic about the economy, is just fallen off a cliff. So I think this is a very big deal, a very distinct change from the attitude of even just a month ago. We've got one more here, kind of similar. Also in the Chicago looking, and if you look back, I mean, this has been very consistent with prior recessions. So for example, in 2015, when a lot of people thought we're gonna have a recession, this didn't say we were. It was, and it didn't say that in 2022 either, but it's really right there at the danger zone currently. And as you can say, this goes back about 54, 60 years. Thank you. That was the chill wind blowing from Chicago. Real retail sales. Now, a lot of times you hear about how strong things have been from from the retailer standpoint, but a lot of that's because of inflation. And if you actually look on an inflation adjusted basis, which is what you do with real retail sales, flat as a pancake for the last 3 years. So I think this idea, and I've heard some people kind of laugh and say, oh, there's no stagflation. And Jay Powell even made fun of that belief here about a month ago. But I think the reality is the economy is losing altitude pretty drastically, and inflation is staying at an uncomfortably high level. So it's, you know, that is a very 1970s type of an event that wasn't supposed to replay, but it is. Okay.
Can I just jump in and add one thing, Dave?
Sure, absolutely.
I would just point out also that the stock market, the message from the inside of the stock market confirms a lot of these kind of macroeconomic things that you're pointing out. So, you know, I talked about the Hindenburg omens and Titanic syndromes, and there's a lot of stocks making new lows within the index. It's interesting to point out that a lot of those stocks are within sectors like transportation, retail, the most economically sensitive sectors within the stock market. So you have a thing like a Dow theory non-confirmation with the industrials making a new high, transport's not confirming that high, which is a famously bearish indicator for stocks and for the economy. But it's, you know, the transportation sector has been dramatically underperforming, and retail, home builders have started to underperform recently. And of course, small caps, you point out. And so Stan Druckenmiller said the best economist he's ever seen is the inside of the stock market. And when you start seeing the inside of the stock market, these types of economically sensitive sectors underperform in the way that they have, it's a time to really start be paying attention to these types of macro signals. So I would just say that the inside of the stock market is saying the same thing as a lot of these macro signals.
Yes, I think you're seeing quite a bit of confirmation. Next one is from you. And I think you're saying something here that I totally agree with, and that's that these official jobs numbers are not nearly as strong as they had looked superficially, and that's a point that, and I think every single one of these Haymaker webinars that we've done, we've talked about this, and you've got here the birth death model. And so anything you want to add to this particular very important thing?
Yeah, there's the headline, employment figures have been suggesting that the jobs market remains relatively strong. Unemployment rate has been ticking up to some degree, but signs like this, like versus the non-farm payroll, you see this quarterly census of employment shows that the jobs market is a lot weaker than the headline non-farm payrolls measures would suggest. I'd also just add that Bloomberg Economics recently came out, I think this week, and said the birth death model specifically is overstated the jobs created by about 700,000 jobs over the last couple of quarters or something. So this is how this always works, is everybody looks to the labor market to decide when we've entered a recession. But it's not for months or quarters after the fact that the recession has already begun that those non-farm payrolls numbers are revised to the downside in a major way. So that's probably what's going on right now. Is the numbers are typically are probably much weaker than what are being reported, but they won't be revised lower for many months to come. It looks to me like that's kind of what we're seeing right now.
I agree. I'll be the first to say the jury's still out on whether we're going into the next recession, but I think the warning flags are starting to fly. More of them are up, and they're starting to snap in the wind a bit more. But if we go to the next one, this is, of course, going to be a major reminder. So actually, this is your image, but this is my little funny of, well, it's not really so funny. It's actually pretty tragic, what I call the 4F scenario, or the federal fiscal funding fiasco. And this is your quote, "No government is more profitable than America's." And that's absolutely true. It's the fact is, as we've talked about in these webinars so often, to be running 6 to 7% deficits as a percentage of GDP when you've got unemployment under 4, superficially strong economy, at least decent economy. It's unprecedented. So I could show tons of visuals here. I think this is an area that we've covered so much. I don't want to spend too much time on it, but it is very important. And it's, there's been some improvement in government revenues, probably mostly because of the strong stock market. But let's flip to the next one and just do kind of a quick summary of this topic, and then let Jesse weigh in on anything he wants to say. But even the economist is pointing out that this is just completely unprecedented. And it's interesting that these treasury auctions, even at the higher yields, have not done well. And that's even with some softening economic data, which you would think would be encouraging. But this bottom line here is what I think is the most scary, is where does the deficit go in the next recession? I listened to Jeff Gundlach, who's considered to be the new king of bonds here recently, and he was saying, we could be looking at deficits of $4 to $6 trillion annual deficits in the next recession. It's just outrageous, and it does raise the fear that there could be a true bond market riot. And to keep financing costs down, the federal government's going to have to be even more skewed to the short end. So they're very heavily weighted on their borrowings to 1 to 2 year maturities. And if that happens, that type of deficit blowout in a recession, it could accentuate that situation. Or you could have a hugely steep yield curve where the long rates are much, much higher than short rates. And I think that's a very likely outcome. Anything you'd like to add there, Jesse?
Yeah, I would just add that I think there's a good possibility that we're already witnessing a subtle form of yield curve control, with the Fed and the Treasury working together to try and keep interest rates lower than they might otherwise be. And that's the Treasury skewing towards the short end, and not issuing as many longer term bonds as they would normally do. And at the same time, the Fed, reining in quantitative tightening at a time when, the inflation numbers certainly don't support any type of a dovish shift in that regard. So I would just say that, the Powell pivot, kind of late last year, the announcement of the tapering to quantitative tightening, the skewing of Treasury policy, issuance. All of these things suggest, and this is something that was in Grant's Interest Rate Observer, Jim Grant, wrote about a few weeks ago, that there's an interesting case to be made that they're already engaging in a shadow form of yield curve control. And I think that's probably the reality of the situation right now, that interest rates are being suppressed and will have to be for a long period of time, and that the real return from bonds could be a lot worse than the nominal return.
Yep, I totally agree with you. And that's a good segue into this section about, is the fourth turning here? It's the Neil Howe book. I don't know if you've read it, Jesse, but you're probably aware of its central themes. I think a lot of Evergreen clients and Haymaker readers, listeners are tired of me bringing that up, but I do think it's important to realize that this is kind of the overarching situation that we're in. I mean, if it's correct, which I believe it is. I think the evidence is just overwhelming. It's a little quote from the guy that wrote, I think, The Rise and Fall of the Roman Empire, but you know, that we are doing some things which are reminiscent of what happened, you know, back when Rome was really declining, and they were one of the early civilizations to debase their currency. You know, back then it was silver and gold, and they would reduce the amount of gold and silver in each coin. But I mean, this is in these cycles, actually, these fourth turning type cycles, which are basically every 20 to 25 years, and 4 of them make up kind of a super cycle. So if you go back 80 years ago, you had the Great Depression, World War II, before that, the Civil War, before that, the Revolutionary War, before that, the Glorious Revolution. But I mean, these things really go back really to ancient times. So it's just this kind of never-ending cycle. They're all kind of different. And, you know, I do think America's got an amazing ability to adapt, which is, you know, different than some of these other civilizations. And I hope that we have the political leadership that will allow us to adapt. But right now it's pretty bleak. So just not too much more on this. We can get through here pretty quickly, but I know this is a topic that you feel strongly about, as do I, this tremendous wealth concentration that we've seen, where a lot of these policies that the government has pursued, especially the Fed, has led to you know, tremendous wealth benefit. And even what's happening now, where these interest rates are up so substantially, you know, that's not so great for the people that are at the lower end, but it's terrific for those of us that have big cash balances, or for the real cash wealthy, cash rich companies. So it creates this tale of two corporate sectors, tale of two consumers. Let's go to the next one. And this is pretty tragic. The number of overdose deaths is just, you know, it's going postal. It's pretty shocking that if we go back, I think since 2012, there have been more deaths by overdose than in all the foreign wars America has fought. It's just a shocking statistic, and I think it's very fourth turning-esque, frankly. One more. Next slide, please. And this is from you, of course, and we're really talking about the two Americas, which I couldn't agree with more. So anything you'd like to add there?
Yeah, I would just say, especially for the readers in your audience, if you read The Fourth Turning, I just finished Bernard Connolly's latest book, You Always Hurt the One You Love. The subtitle is Central Banks and the Murder of Capitalism. And it's a fantastic read, 600 pages, so don't get it unless you're ready to really commit to it. But he makes the case, he's a, you know, a long-serving economist, European economist, Englishman, who makes a very interesting case that really since the Alan Greenspan time, and in the wake of the dot-com bust, the Fed was forced to kind of blow the housing bubble, because when you have a bubble, it pulls forward demand from the future. And so when that bubble bursts, then you're left with a vacuum of demand that would cause a Great Depression type of a thing. And so the Fed was so worried that the dot-com bust was going to create another Great Depression, that they had to blow a housing bubble. Housing bubble burst. We had the great financial crisis, and they lowered interest rates to 0, had to create the everything bubble, as I've called it for the last 10 plus years, which is, you know, bubble in stocks, real estate, and the bond market. And I think this latest one that we've seen through the pandemic was, you started to see, you know, obviously the economy shut down during the pandemic, and they needed to blow another bubble to prevent another, I guess, vacuum in demand. And so added to the everything bubble, we've now created a fiscal bubble. where, we have to continue pulling forward demand from further and further in the future to prevent this big kind of vacuum in demand from materializing. So it has to get bigger and bigger to prevent, this downturn, which in normal business cycles, right? If you just allowed the normal business cycle to play out, you'd have a boom, and we wouldn't even have a boom and a bust. You'd have an economic expansion, recession, expansion, recession. But this mindset among the Fed is we're going to do away with recession, and what you do is you create bigger and bigger imbalances. Connolly calls it intertemporal disequilibrium, where you've messed up the demand, by pulling demand from so far into the future that it creates a real problem in terms of normalizing interest rates and these types of things. And so I think we are in this situation where if the Fed were to allow the economy to kind of, or the rate of interest to go to neutral, it's true market neutral, you would have a crash in the economy, right? We're already seeing major problems in regional banking and all of these kinds of things. So we are in a very unique situation, and it does kind of play into this idea of a fourth turning that Fed policy has come to the rescue of asset owners, and by blowing bigger and bigger bubbles through time, and it's created this divergence in society where if you're an asset owner, you've done great, but if you don't own assets, life is pretty miserable right now. And if you think about, graduating with $100,000 of student debt and trying to pay that off, and then not to mention trying to, buy a house with today's home prices and mortgage rates and things, it's a pretty bleak situation for a lot of people out there. And I do think that something has to change. And so
Well, I think it's not only bleak. I think it's socially destabilizing.
absolutely.
And I think that's why you've got half of Americans that are worried about some form of a civil war. And I think this election coming up is really ominous in that regard. And so,
well, the spoiler alert, I'll tell you that, Connolly's conclusion in the book is that we're either going to move towards socialism or authoritarianism, because people are done with the way things are working right now, or not working for them under the form of capitalism that's been created by an overactive central bank. And so it's not a very optimistic outlook, but the odds are that we're headed for either kind of an or down that road towards authoritarianism or down road towards socialism.
So just to interject a little hope into this, because this is something that I've wrestled with a lot in my my podcast and also in my writings, but I do think there's solutions. I think America is uniquely blessed in its ability to come up with solutions, but our policymakers, unfortunately, are just clueless as to what we need to do. And frankly, I think this chart here has got a big hint as what we could do to rectify the situation, but that's a topic for another webinar. But I guess I just want to leave people with the idea that there is a way for America to cope with this. My gosh, if Weimar Germany could get out of its hyperinflation when it really had no assets after World War I, the United States, with its enormous wealth, both financial and natural resource, we can do it. But boy, we're not thinking the right way right now.
Well, I would just say Janet Yellen, my friend Jim Bruce made a movie after the great financial crisis called Money for Nothing. Maybe you've seen it. It's a fantastic documentary about the central bank, and it wasn't in the movie, but there was an outtake that he shared on Twitter maybe 5 or 7 years ago of Janet Yellen saying somehow we have to find a way to run this economy without being reliant on asset bubbles to support it. And I think that is the key, is trying to figure out how to to stop blowing bubbles in order to try and support the economy and get to something that's more sustainable, more real.
Proven to be a hard habit to break, unfortunately, but it's so true. So we're running on a little bit on the long side. We've got an AI section here, but we'd already touched on AI. Let's go here real quickly and just see if there's anything we want to talk about before we go Q&A. For all you Bob Farrell fans out there, I've got his top 10 investment recommendations, which I think at the tail end of a bull market are especially important to look at. But we just real quickly, high interest rates are, I already talked about this, feeding the wealth to buy. But if you're not aware, credit card interest rates are now 24%. and credit card defaults are soaring, auto loan defaults are soaring, small businesses are really being hurt by these high rates. So it's a, it's a very much of a, I call it Dickens of a problem, from Tale of Two Cities. It's a tale of two economies. And unfortunately, I think that we're at the stage where now the part of the economy that's been perhaps a beneficiary of the lag effect, where it takes a while for these higher interest rates to bite. Now it's starting to really hit home. So enough said on that. AI, we've got NVIDIA, of course, to talk about. And this is a piece from you, AI is Year of Disillusionment. I'm seeing more and more on this, Jesse, that whether it's Wall Street Journal or Barron's, even some tech folks, that there's just too much optimism about how quickly the benefits from AI are going to happen. And you mentioned already, let's go to the next one, with NVIDIA having a $500 million increase in its market cap in just like a week or less than a week.
$500 billion.
Did I say billion? $500 billion. Sorry.
Yeah. The numbers get so big. It's
I know, that's thanks.
Yeah, I would just point out that this is the history of disruption and new technological innovation. You think about back to the internet, and there was the dot-com bubble, right? And there was a massive amount of spending on infrastructure. You had companies like Global Crossing laying fiber optic across the ocean and these types of things, and the investment ends up becoming overinvestment, and I think that's where we are right now, where just the payoff for a lot of the stuff is many years down the line. There aren't really a lot of products that people are willing to pay for yet in terms of AI, but the spend is off the charts, which is I think what NVIDIA stock price is really most representative of, is the massive spend from Alphabet, Microsoft, Meta, all these companies that are buying the chips to train large language models and these types of things. But there's always that gap between hype and reality, and I think the hype is off the chart right now, while reality has a lot of catching up to do. And when you get to that point in the cycle, you're going to see a lot of pain on in terms of, just like we did during the dot-com bust. A lot of companies go out of business. A lot of spending will prove to be wasteful, and that's a pretty bearish part of the cycle. I think that's where we're just entering into now, is where the hype is the reality's starting to fail to live up to the hype.
I think you're right. Okay, let's just put up the barrel 10 rules to remember. Oh, this actually, I just came across. This was pretty funny, because Berkshire Hathaway stock supposedly fell 100% in one day. I think it was actually yesterday, and it was because of an AI misinterpretation of because it was some kind of a trading glitch. And so it just illustrates what you're saying, that this AI thing isn't really quite ready for prime time, and we have they call it hallucinating when it comes up with just really weird data, and it requires humans to say, look, that just doesn't make sense. So
right, Google search, the AI integration has been telling people to eat rocks and put glue in their pizza sauce, and crazy stuff, right? It's pulling from social media, it's pulling from Reddit and all these other things. Is just learning bad information and spitting it back out, and that's one of the problems. That means this generative AI is not just not ready for prime time. It's certainly not ready at all for mission critical stuff in any respect, because these types of hallucinations and errors and things are built into it, and there really is no prospect of resolving them.
No, good point. It's a very powerful tool, but it's got some significant challenges, that's for sure. Okay, we want to get to the Q&A. So there's the Bob Farrell ones. We won't spend any time on it, although I think that would be good for everybody to reflect on, especially those highlights, because I think we're seeing a lot of that, particularly if you look at number 7. Markets are strongest when they're broad and weakest when they're narrow, and that's exactly what we're seeing right now. And what we've also seen number 9, where all the forecasters and experts have agreed that we're going to have a soft landing. Be prepared for something else to happen. Okay, let's open it up.
If anyone has a question, feel free to raise your hand or type it in the chat. It looks like Jeff Harbaugh, you're up.
Good morning. I was wondering if you guys have any tech stocks or tech sectors that you like at current valuations?
I should take that one because that's really more related to, portfolio management. So, Evergreen has a lot of technology in their portfolios. We tend to be more growth at a reasonable price. So we would gravitate more towards a Google or a Qualcomm, which, by the way, is up 100% since last fall and was very reasonably priced at that point. Taiwan Semi, some people might remember that in the January webinar, I brought that one up, and it hasn't been quite NVIDIA, but it's had a really nice move. And to me, it's I mean, my best performing stock, as I wrote up yesterday, my career was Qualcomm in 1999, but it had gotten crushed during the Asian crisis of the fall of 1998. It went up 2,600% in 1999, which might have saved my career because I had a lot of value stocks that were going the wrong way back then. So I think you just want to be mindful of risk reward, that when you pay a very, very, very high multiple for a stock, you can be right, but boy, there's a tremendous amount of pressure on those earnings continuing to grow. And I think NVIDIA is in that category right now. And I continue to think, because it's a chip stock subject to over ordering, double, triple, quadruple ordering, at some point there's going to be a major disappointment and the stock's going to get hit. But for now, it's got enormous momentum, and I haven't been negative on it. Where I've saved my negativity are things like MongoDB, which you may have noticed has been absolutely crushed. That just made no sense to me. That's valuation of back a few months ago. So I don't like to be blanket bearish or blanket bullish. I think you just have to look at each individual situation to see if there's an attractive risk reward.
Thank you.
Sure.
From the chat, what is the downside for oil and oil stocks with the downturn in the economy that has been alluded to?
You want that one, Jesse?
Sure. I mean, I think that, generally my attitude towards these commodity sectors is I'm in a buy the dip mentality. I think when I look at the long-term, prospects for long-term secular bull market commodity super cycle, I want to be scaling in on weakness. Whereas in terms of a lot of these other things, technology sector and thing, I think it's sell rips kind of a mentality. I do think the oil price is kind of falling back right now to an interesting horizontal support level. I did we did share that chart of the Bloomberg commodities index, and there is good support there that it's just breaking out of. But oil price around 70 has pretty good multi-year from a technical standpoint support. And I think there's also good support from the fact that the administration wants to needs to refill the strategic petroleum reserve, right? There's been a massive outflow from that, the largest we've ever seen since it was created. And so I think there's a bid underneath the market that will be there persistently. That's also the flip side of this AI thing, is we're seeing demand for energy, for electricity, grow for the first time in many, many years, and grow in a major way. This is through because of things like the growth in these data centers and things that are needed to train large language models and this type of stuff. So I think that the demand for energy is going to be another positive support for demand for things like natural gas and gas-fired electricity and these types of things. So I do think that that we're probably closer to the bottom in things like the crude oil price and natural gas than any sort of major top.
Chime in there, Jesse. I don't know if you saw the Dallas Fed estimates that the cost of a new barrel, even in the Permian, is $70 a barrel. So that would imply that, if they're even close, that 70 is going to be a level at which you're going to see, well, for example, even a further decline in the rig count, the drilling rig count, which is already down a lot. But I also would say that with these commodities, that I think I get maybe appropriately carded as a perma bull on commodities. But our history at Evergreen is when we get these big rallies, we take profits. And we did that in a huge way with the gold miners in 2020 when they had that monster move. And we've done that repeatedly on, big rallies. And we've even done some firming here recently on gold and energy when it was stronger. So, it's fine to have a core position and really believe in the long-term uptrend, but I think it's also very important to take some profits when you get the nice moves. So Okay, I think we have somebody else that has a question.
Looks like there's one more in the chat, or a couple more in the chat. The S&P rallied more than 1% in the last 30 minutes of trading on Friday, which was the end of a week and the month. Any thoughts as to why?
And by the way, energy was up like 3%, almost all of it right at the end. So I don't know, that did look a little artificial to me. Jesse, did you have any thoughts?
Yeah, I mean, it did. It was difficult to understand. We could speculate onto what it was. I mean, there's all types of rebalancing and things that happen. A lot of the I know that you know, ETF rebalancing and all that kind of stuff. A lot of that drives the last 10 minutes. So there could have been some major institutional repositioning, rebalancing that was going on, and drives what, you know, what happens within those ETF portfolios. But yeah, it did look a little artificial to me as well.
Looks like we got Tiemann's raised his hand. Go ahead.
Hi, Tiemann.
Hey, Jesse and David, appreciate all this. Jesse, I'm a subscriber for a few years, and I just appreciate your great work. This latest market comment, what if interest rates are both too low and too high, I thought was interesting. You mentioned they could be too low to return inflation to 2%, but also too high to prevent a recession from happening. Kind of got me thinking, and if we do happen to get into a recession, maybe even a severe one, is there potentially a threat of deflation at all? You know, particularly given all the government debt, or can we always count on the government to just overprint and overspend, you know, a la MMT, to prevent deflation? And then finally, if we do have a threat of deflation, how do you think precious metals and hard assets would hold up, you know, considering real interest rates would actually be down?
Yeah, it's a good question. I think the deflation question, you know, I made the point about these bursting bubbles, and a bursting bubble in its nature is deflationary, right? It's what Alan Greenspan was afraid of in the early 2000s. It was what Ben Bernanke was deathly afraid of in the wake of, you know, the 2008-9 stock market crash. I think, you know, with where government debt is today, there's no way that the Treasury or the Fed would allow deflation, right? Deflation is you know, the worst possible thing for a debtor. It's great for you know, for those of us who you know, are primarily spending and want lower prices to buy things. But it's you know, it's worse than hell, you know, for a debtor. And so I think that if there was and I think this is why you have the Fed biasing towards allowing inflation to remain elevated, right? Because if you were to bias towards, let's bring inflation back down to target and potentially risk a deflationary crash, right? You're risking you know, creating a debt crisis. And that's, I think, what would, you know, Jay Powell probably weighs that in his head. Okay, would I rather be the guy who created a debt crisis because that was too hawkish, or I was the guy who allowed inflation to remain elevated above target, you know, and be the next Arthur Burns? And I think he's made that decision and said, I'd rather be the next Arthur Burns than the guy who played catalyst for a debt crisis. So I think when you have to think about that in terms of what is the, you know, prospect of the potential for deflation, I think that it's very clear that you know, that would be the worst case scenario for the fiscal, you know, situation. And so for that reason, they're going to do everything in their power to prevent that outcome.
So basically, just no threat of deflation is the way you see it. So
I don't. I think that
I
right
agree.
now, basically, yeah, you know, part of this shadow yield curve control is, you know, the Fed and the Treasury need an elevated level of inflation to try and inflate the debt away, but we also need to keep interest rates below that level of inflation in order to make the debt manageable. And I think that's really what they're going to do, coordinate together to try and make that prevent a debt crisis. I think they have to.
I think it's fair to say you're going to see pockets of deflation. In some ways, you already have. I mean, we've seen a lot of commodity deflation over the last couple of years, though that appears to be largely reversing. If we're going into a recession, those pockets of deflation will probably become more numerous. But it's the response to the recession that I think is going to trigger the next upleg in inflation. Again, listening to Jeff Gunlock, he's saying he thinks there's going to be a Pavlovian bond rally if we go into a recession, or it looks like a recession is a distinct possibility. But then what happens next is why he thinks, and I think, you're going to get another major upleg in interest rates and higher inflation. So yeah, the Fed's in a real tough spot. There's no doubt. But frankly, they put themselves there. They printed themselves into a very tight corner.
Thank you.
So we had another question that came in.
Yeah, we have one more in the chat. Everyone says inflation is bad for stocks, especially when starting from being very overvalued as they are today. But historically, what happens when at the same time the government has such a loose fiscal policy?
Well, that's actually a very good point, because I read people saying, well, if you think there's going to be a lot of inflation, buy stocks. And it's true that in economies that have had hyperinflation, Zimbabwe, Turkey, the Weimar Republic, Germany, common stocks have been a good way to preserve wealth with very high inflation. But what they don't typically say is when you go from low inflation to fairly high inflation, that's a really tough period for most stocks. And that's what we saw in the 1970s. Now, there were stocks and sectors that did very well in the 1970s. And I think we're wise to reflect upon those, because there are so many similarities. There's differences. We're way more in debt now than we were then. But yes, I think it's a good point. And so there are stocks that are inflation beneficiaries, but frankly, most are the other. They lose when inflation gets too high, similar to what we saw in 2022, a real life example recently. Jesse, would you add anything to that?
Yeah, no, I would say typically, the earnings yield on the S&P 500 is closely correlated to real yields, long-term TIPS yields. And there's a huge gap today between those, where long-term TIPS are yielding 2% plus real, and which would suggest valuations should be much, much lower today. The earnings yield should be much lower today. So either we're going to get real interest rates coming way down again to justify stock prices, or you're going to get valuations come back to some semblance of normalcy. I think really what explains the gap right now, the valuation in equities versus bonds, is the estimates of long-term earnings growth. And my friends at Top Down Charts have put up a great chart in this regard that shows literally right now the analyst estimates for long-term earnings growth for the S&P 500 are about the highest they've ever been. The only other times we've seen anything like this is kind of at the peak of the dot-com mania, when analysts were estimating, forecasting huge earnings growth indefinitely out into the future. And that's why I say, if that doesn't materialize, if AI doesn't kind of create this earnings boom that's priced into markets, then you're going to get that reconnection of equity valuations with interest rates. And yes, I think it's true that in examples of hyperinflation, owning stocks is one of the good ways to protect yourself. But hyperinflation, we're talking more than 20%, rates of inflation, significantly more than 20% annualized. And so we're not anywhere near that today. And so I think kind of making the case that, buying stocks at record valuations today to protect yourself from hyperinflation, there's just not the data there to support that just yet, in my view.
Matt G asked, what are your favorite international markets for the next 3 to 5 years?
Well, I would throw out Japan, which has been a favorite of mine for quite a while. I think South Korea at some point was going to have a rebound. It has not been performing nearly as well as Japan. I think Brazil is interesting. A lot of these emerging markets, frankly, I think are running more rational economic, fiscal, and monetary policies than is the U.S. So, for example, in Brazil, their 10-year is yielding about 10%. and inflation's running about 5%. So they've got about 5% real interest rates. They have much lower debt levels than we have. And I think we have kind of this Western bias against emerging markets, in some cases well-deserved, and some of them are still basket cases, but a lot of them have come quite a ways in terms of behaving more responsibly. And I do think it's interesting to watch what's going to happen in Argentina with their new, very extreme policies to try to get inflation under control. And it's amazing to me that with all the economic pain they're experiencing to go through that their president is as popular as he is. But Jesse, anything you'd add there?
Yeah, to me, it's the last year or two, I've been very interested in Chinese tech stocks. Talk about, a sector of the broad, global markets that is out of favor, right? Nobody wants to own China, but there's a huge dichotomy between the valuations of Chinese tech stocks versus US tech stocks that are 100% dependent on Chinese production, right? So the same people who are saying I would never touch Alibaba are the same people that own a ton of NVIDIA stock, right? And NVIDIA 100% dependent on producing their semiconductors in Taiwan. So I think when at the same time you have the Magnificent Seven trading 50 times free cash flow, you have these big Chinese tech stocks trading at single-digit price to earnings ratios. And there's signs that China is starting to turn its economy around. To me, that's a very interesting, potentially a Paris trade, is kind of avoid the Magnificent Seven, and go long, some of these stocks like Alibaba that are dramatically undervalued in comparison.
We have a question from Ken.
Yes, thanks for the session. Quick question. Do you see any risk in US stocks due to the situation with the yen potentially impacting the carry trade? Or do you think Japan's going to pretty much hold their position and there won't be much of an impact to US equities?
Yeah, that's near and dear to my heart, because I think one of my recent themes is the market is so focused on the 10-year JGB, the Japanese government bond, which is the one that has had a tremendous amount of yield curve control, though it's been going up sharply in yield, down in price. But if you look at the 20 and 30-year part of the Japanese bond market, where the Bank of Japan doesn't control the interest rates have gone nuts. And the 30-year is now 2.2%, and looks like it's still going higher. And it's breaking through I think it's taken out the 11-year upside resistance. So if that happens, and these Japanese companies, and Mrs. Watanabe, she's the mythic Japanese investor. Apparently in Japan, it's the female of the household that controls the purse strings or the investment strings. And if they start to repatriate capital back in a big way, because they say, look, we can get a decent interest rate on long-term government bonds, and we're taking advantage of our super undervalued yen, which I think is an underappreciated aspect of the whole bond play, is, if you have a really overvalued currency like the dollar and you're holding US treasuries, I think you got to take into some kind of reversion to the mean or normalization of the currency, and that's going to be a big hit to the income. So I think that you're right. I think that what your implication is right, that if these interest rates keep screaming higher in Japan, at some point this carry trade, where there's trillions of dollars that's been moved from Japan, and in many cases borrowed, where, say, even Western hedge funds will borrow at almost zero in Japan and then invest in much higher yielding assets in the West. And if that unwinds, it could be really ugly. Jesse, do you have thoughts about that one?
Yeah, I would just add that it's not just Japan. I've seen research to show that Korean retail investors and Chinese retail investors, due to the strong dollar and the strong stock market, have been big buyers of U.S. equities. I saw something in Bloomberg a few weeks ago that suggested that Chinese investors, retail investors, were so desperate to get outside their own home markets and buy U.S. stocks that they were willing to pay a 50% premium to net asset value on a lot of these stocks like Magnificent Seven. So, the kind of a tech equivalent fund in China was trading 50% above net asset value, because retail investors in China were so desperate
to turn the volume down when you went up.
own a lot of their own US stocks. So I think it's not just Japan. It's been foreign investors generally. A lot of Asian investors have wanted to, because of the strong dollar and strong stock market, strong performance of the Mag 7, kind of trade on that, take part in that momentum trade.
Great, thanks.
I don't know how many more questions we want to take, but there's one more in the chat from Scott. When does uncertainty regarding the outcome of the US presidential election cycle begin to influence equity markets?
You would think soon.
Yeah, it's a great question. You would think that markets discount, right, or discounting mechanisms, and they typically discount. I'm a fan. I mentioned Stan Druckenmiller earlier. He says, to understand where stock prices are going to go, you got to imagine what the world will look like 18 months from now. So you would think that the stock market is going to be already wrestling with this. We're less than 6 months away from election day. So trying to imagine what the world looks like in 18 months is really difficult if you don't know who's in office. Especially, in this election, it's going to be a big difference. I think one of the key things that I'm focused on is, Trump's elected, he's going to want to renew those tax cuts. If he doesn't get reelected, Biden's going to want to let those tax cuts expire. That was a big driver of stock prices after Trump's election, was the reduction of the corporate tax rate. I think that's probably, to me, the biggest thing that's hanging over the market right now is what is that tax rate going to be?
Good point. I think where there's commonality is if Trump wins, there's going to be a heck of a lot of money spent, big deficits. If Biden wins, there's going to be a heck of a lot of money spent, big deficits.
Right.
And we don't have the choice between a budget warrior, discipline, and one that's going to let kind of continue the process that we're on, our path we're on. So in that way, it's kind of similar, but how you get there, and of course, one of the problems with higher taxes is you typically don't get much in the way of additional revenue. So even if that's an attempt to try to make the budget look less horrible than it is right now, I'm not sure it will succeed. But it's a pretty grim situation in my opinion.
Last one from the chat. After the South African election, what is the best palladium stock?
Okay, so that one I deserve because I do like palladium, and it ran up kind of briefly and then it's been hit hard. There really aren't very many equity ways to play it. Stillwater, which is South African, is one logical way to do it. But yeah, there's a lot of political turmoil in South Africa. It's not a great country to have 80% of your operations in, which is the case with Stillwater. So I think the safest way is if you like that, because if they were, for whatever reason, shut down or their production was greatly impaired, you would think that palladium prices overall would go up sharply. And kind of the bull theme with that one is the idea that EVs are basically flattening out, and where the real growth rate is going to be going forward with with low carbon vehicles is going to be with hybrids. And hybrids actually consume more palladium than do internal combustion engines, whereas EVs consume none. So that's one reason why palladium is so depressed, is because the viewpoint has been EVs are going to take over the world. And I think that's wrong. I think we're going to see hybrids be the real growth rate. You can see that happening in China right now. And China, of course, is the most important automobile market and EV market in the world. But it's going to take, so it's probably going to take a couple of years for that strategy to really work out. I don't think it's going to be get rich overnight with palladium. Jesse, you probably don't follow that commodity.
No, but I do follow the auto market, and I can just say from experience, I know Toyota is really the only company building hybrids across the model line. The new Land Cruisers, 4Runners. Bought my mom a new Prius recently, helped her buy one, and they're very difficult to find. These hybrids, they're in such high demand. Consumers want them because they're you get all the efficiency from the hybrid engine, but you don't have to deal with the inconvenience of charging and things. And so I think, and then the flip side, you look at EVs and inventories are just off the charts for a lot of these companies, just can't sell them. Tesla has been famously dropping prices, seems like weekly, to try and move vehicles. And so, yeah, you're absolutely right. The demand for hybrids is there. Demand for EVs is just not there right now.
Nor do I think it will be. I really do think we're going to have the fastest growth over the next 10 years in autos is going to be emerging markets. And I think EVs are particularly problematic in emerging markets, given the unreliable grids, difficult to recharge. And hybrids just, I think you're going to see policymakers, even in the West, start to really push the hybrid solution. And it'll be, kind of a stealthy transition, but I think it's a transition that's going to happen.
I think it's a good point too. I mean, there's a lot of these in between steps that we, to get from here to there. If we want a green revolution, you can't just say, okay, we're going to stop using all kinds of, fossil fuels, right? There has to be these in betweens. And I think hybrids are one way. Natural gas is going to be a really important part of, meeting energy demand over the next several years. And so while everybody wants to go straight from, coal to solar and wind, there has to be, an in between. And same thing with, with the autos, right? You can't just go from, gas and diesel to, all EVs. There has to be an in between. And I think that is where the opportunity is.
Agreed. Well, we've been going a while. Are we going to call it quits, or do we have some pressing question out there? Okay. Was that you, Jeff? Do you have another one? Jeff, you have a question?
If I've got one more, sure. Could you guys talk about private credit and private equity a little? And I'm getting some vibes. And then the other day I saw that Harvard had to borrow money, at least for operating expenses, when they've got 50 or 60 in endowment and they got liquidity issues. And that kind of focused my attention.
Well, Jesse, I know you got strong opinions there.
Yeah. Well, I would just say that there's so much money has gone into, private capital, private equity, private credit, in the last decade, because the pitch has been, we give you better returns than public markets and with less volatility. What they don't talk about is the, far less liquidity. And in, difficult market cycles, liquidity is always king. And so I think we're running into a time. We saw, there was a couple of, just over the weekend, a couple of private credit funds in Canada that announced they were stopping payments. I think these are probably the types of early warning signals you would typically expect to see, heading into a period where liquidity becomes an issue. A lot of these firms, have been just borrowing to make, dividend payments and continue paying investors, and they can only do this for so long before they have to start shutting down, payments to investors and these types of things. So that's where we are, and I do think, yeah, there's a real risk that it could get worse before it gets better.
I would agree with that. I mean, it's one of the considerations is that as interest rates have gone up so drastically, as a creditor, you go, especially if you've got private credit, which is typically floating rate, you go, terrific. Well, it's terrific as long as the companies can actually pay the debt, service their debt. But a lot of these companies, I don't think can at these rates. And I think you're going to see a lot more defaults. I think it's going to be an area where if you're with the strongest private credit companies, deepest management teams, great, credit risk underwriters, seeing the best deals, you'll probably be fine. I mean, that's not to say there won't be some hiccups and defaults, but you'll probably get through with a decent rate of return during the next down cycle. But I think some of these entities are going to have really serious pain. But before
I think
I want to make sure.
I was just going to say, you can watch the public markets for starting to price this stuff in, right? I mean, corporate spreads have been so low that essentially they've priced in no risk of any problems in credit. Just today, I've noticed that we've started to see some weakness in high yield spreads, just kind of for the first time in a while. So to me, that when you start putting these types of things together, I'm just going to watch spreads, and if spreads start to go, continue to go the other way, that's a sign that markets are starting to recognize these problems are growing. in credit generally. So I think the public markets can kind of give you a clue as to what's going on with this private stuff.
And to your point, we're seeing some significant spread widening in triple C's, which is kind of the junkiest part of the high yield market. So I think that's a canary in the coal mine that's starting to teeter. But I did want to make sure that anybody that's listening here knows how to reach you, Jesse, how to get your great work. You have some of the quick reads that you put out each week that are terrific. So how can they locate you?
Yeah, my website is thefelderreport.com. I put out a free blog post every week that's just kind of highlighting some of the charts and articles that I found of interest. And I'm pretty active on Twitter, or as X, as I think it's known now. It's just at Jesse Felder. And you know, I try and share a lot of the stuff I'm reading and seeing there as well.
Great. And when we do the edited version, when we do the little clips that go out to the masses, we'll make sure that that's included. So thank you for that, Jesse. Thank you, everybody, for your time, your attention. A lot of great questions. And feel free, if you've got thoughts you want to email to us after this, don't hesitate.
Thank you, Jesse.
Thank you very much. Thanks, Jesse.
Hey, thanks, Dave. That was a lot of fun. Appreciate it.
You bet. It's cool to have you on. It's about time I did payback.
Well, it was an honor to do it. So thanks for the invite.
Absolutely. We'll do it again.
Thank you, Jesse. Bye-bye.
Say hi to Aaron for me.
All right, we'll do.
Thanks. Bye.